Okay, we're going to go ahead and get started. So hi, everyone, and welcome. Thanks for joining our webinar today. Today, we're talking about U.S. trade negotiations. My name's Kate Hubbard. I'm the Director of Marketing here at ArrowStream, and I'll also be today's webinar host. Before we begin, I would like to give a brief overview of who we are, as well as give a quick update on some of our latest developments, just for those of you who aren't familiar with ArrowStream. So ArrowStream is a supply chain technology company for the food service industry, headquartered in Chicago. We're proud to work with our customers in our network, which include over 200 restaurant chains, over 1,000 distribution centers, and over 6,000 food service suppliers. In the last year, we've invested heavily in our solutions, and we've seen significant growth in the adoption of our technology. So today we have several solutions that span the key supply chain roles, and most recently we launched a sourcing solution for chain operators. And so this enables our users to run a standardized and repeatable sourcing process within the procurement operation, which could include sourcing new products, improving service and food quality, as well as lowering food costs. And our sourcing workflow combines several powerful components that help our food service buyers focus on high-value sourcing opportunities, as well as improve collaboration among their supply chain partners. And one of those components is intelligence on over 200 commodity markets. So like the insights everyone will receive on today's webinar, our sourcing users can also access this intelligence on a daily basis. I also want to mention a new weekly email that we launched last week, which gives an overview of key commodity markets and other vital news for the food service industry. So this email will go out every Friday morning, and it includes ArrowStream's commodity price trends on key markets, various trends to watch, ArrowStream's restaurant commodity index, and information on upcoming webinars and other useful resources. And speaking of webinars, I wanted to give everyone a look at what we have in the next couple of months. So on June 27th, we'll be sharing some of our best practices for your sourcing strategies. And on July 18th, we'll be giving an update on the U.S. corn crop and looking at the impact it may have on other commodity markets. So definitely keep an eye out for those emails to register within the next few weeks. And then lastly, before we get started, I want to direct your attention to the GoToWebinar control panel. We do encourage everyone who has a question to ask it. There is a questions box that you can type in your question, and we will have time after the presentation to answer those for you. So with that, I'll go ahead and introduce our presenters for today. First, we have David Maloney, who is EVP of Analytics at ArrowStream. Before being acquired at ArrowStream, David was the president and founder of the American Restaurant Association, and he has been advising food service clients about commodity markets and contracting since 1996, and his expertise has been utilized by thousands of companies in addition to several media venues. We also have Dr. Isaac Olvera presenting today. Isaac is the commodities and data analyst at ArrowStream. He is a blockchain traceability expert and holds a master's in forecasting and simulation modeling, as well as a PhD in animal science production economics. Isaac formerly worked with Informa Economics within the various meat proteins with a heavy emphasis on beef. And lastly, we will also hear from Jerry Dalton today, who is ArrowStream's Director of Commodities. Jerry has over 20 years of physical and financial trading experience, along with forward contracting, hedging, and purchasing capabilities. And prior to ArrowStream, Jerry worked with multiple commodity companies, including Cargill. So thank you to everyone for being here today. I'm now going to hand it off to David to get us started.
Sorry, talking on mute. Thanks, Kate. Thank you for everyone for being here. Obviously, this is an important subject. We've had these ongoing negotiations with China and several other countries and it is definitely impacting commodities for the restaurant industry. But let's dive a little deeper here and why it really matters. Okay, so on the next slide, U.S. agricultural trade has been growing for sure. In this first chart, this is exports and imports, and this is in billions of dollars. And we can see since 2000, we've more than doubled exports and more than doubled imports. We point out that 2018 had the smallest net export gain in 12 years. Makes sense because we started having some trade challenges, if you will. The other thing I want to point out on this is how important exports have become to the ag economy in the U.S. This table on the right side of the slide is a ratio of farm receipts or the farmer income versus the agricultural export dollars. And basically, the higher the ratio, the more important or the bigger share agricultural exports have played in those farm receipts. And you can see that pretty much for the last decade, we've been at escalated levels. So make no mistake, the trade challenges that we've had in negotiations, and I'm not saying that they aren't warranted and needed, but make no mistake, they are impacting the agricultural community here in the United States, which in turn is impacting and will likely continue to impact prices for the restaurant industry. So let's talk about exports. And what I really want to do here, and what I really challenged us as a group, is let's drill down and focus on what's really important here, because we understand that you all wear a lot of hats and don't have a lot of time to spend on the trade issues. So what our takeaway here is we want to get you focused on what we think is important to monitor here, okay? So let me give you a little background. We're going to give you a little background on exports and imports and then drill it down from there. So let's talk about the export players here. In this pie chart, we can see the top 5 here. And South Korea is a little hard to read, but it has that blue section of the pie. But South Korea, China, Japan, Mexico, and Canada are top 5. They account for roughly 50% of our export dollars, okay? Now, we still have 50% in the others category, and we'll talk about that others category and how important that is. But I would offer that our focus really needs to be here. The highlighted yellow countries are countries that we currently have negotiations, or whatever you want to call them, disputes with, okay? And we're going to focus down. Like I said, we're going to focus on the top 5, but particularly we're going to focus on the 4 of the 5 that we're having negotiations with.
Great to see everybody.
Now,
Ethan.
Yep. Hi, guys.
We'll talk to you soon. Thanks.
Okay, so as far as top 10 aggregates or categories that we are exporting, you'll notice that corn and soybeans are our top 2. And that's important because those are your feed ingredients for the major exposures to the industry, right, which is the proteins and dairy. But you'll also notice that beef, pork, and chicken are all in the top 10, carrying, I mean, in the case of broiler meat, not as big of a percentage, but, you know, make no mistake, a large percentage of our production, roughly 10% plus of our chicken production is exported. So exports are going, and how they flow are going to impact prices here, okay, for the restaurant industry. That's okay, Kate, you can move forward. As we drill down into those major countries further, and we lump the European countries together into the European 28, okay? This is kind of a messy chart, but bear with me here. This is the agricultural export dollars going to various countries. Now, a couple of things that obviously stand out to you. First, China, Hong Kong, right, which peaked 2011, 2012, and has been on the decline. A large part of that before 2017 was lower soybean prices, okay, because soybeans are by far the #1 export item to China. back 2012, 13 when we had the drought, we're talking about $15 soybeans. Now we're talking about $8 soybeans, right? So a big difference. But would also stand out is a drop off from 17, 18, and that's not just soybean price. Okay, that is a significant decline in trade with China. You'll notice that growth has been pretty good for our neighbors in Canada and Mexico, and they remain important. But as we'll talk about in a little bit, the opportunity there for increased exports isn't all that exciting. Okay, and then you notice the shares from the other partners here have been kind of flattish for the last decade. Part of that again is kind of commodity prices coming off, but growth hasn't been overly exciting. Okay. Now, if we do want to address imports, and like I said, we're going to focus on the mostly on the export items. But next slide, Kate. The import players, again, we can focus on the top 5 because they account for about 50% of our agricultural imports. Notice Mexico, all right, number 1, Canada, number 2, all right, and we'll talk about that relationship here shortly. Yes, we import some product from China, not overly concerned about the Italy and France. Again, the yellow highlighted items are countries that we currently have negotiations or disputes with. But the difference I would point out here are the items, okay? And look at our top 10 import aggregates, okay? Fresh fruit and other fresh vegetables except potatoes, grains and feed, wine, coffee, beef is there, okay? And I'll talk about that more in a minute. But the risk in us losing imports as far as the impact on the food costs for the restaurant industry as a whole, okay, in our opinion, is not as big as the risk on exports. Okay, now Mexico, right? President Trump, we have new tariffs again starting on Monday, right? 5% on imports from Mexico. We have the tomato suspension agreement, which ended roughly 5 weeks ago. Which the United States slapped on a 17.5% tariff on imports of tomatoes from Mexico. Tomatoes, avocados, any kind of vegetables we're getting from Mexico, if you have risk there, then obviously this is a risk to you, okay? But as far as the rest of these items here, the only one that really stands out is beef, okay? And a lot of that is lean beef. So a lot of lean beef we're getting from Australia, New Zealand, South America, and we'll talk about that more in a minute. But there is a risk here in this disruption of trade flows that we'll talk about with African swine fever about lean beef. Okay. Next slide, Kate. So let's talk about what's going on with the ongoing negotiations, okay? The United States, Mexico, Canada agreement, okay, or the new NAFTA, is progressing. Probably the best news we heard on this was Congress was sending a team down, Democrats were sending a team down to Mexico City to negotiate some last-minute issues around labor, et cetera. Just the fact that they're sending people is a good sign. Obviously, the new tariffs that the Trump administration has initiated could slow this down, so this needs to be watched. Canadian government needs to approve it too. Let me step back. The steel and aluminum tariffs have been lifted, and so that was a big hurdle. So for the most part, we think it's likely we get a deal here before the end of the year. We do get some expanded access for dairy, poultry, and eggs, but quite honestly, it's not anything to get overly excited about. And we'll kind of show that more in a minute. Negotiations with Mexico, United States, Mexico, Canada agreement, progressing. Mexico has lifted pork, dairy, and other retaliatory tariffs they have on imports of U.S. ag goods. Their government needs to approve. Ag benefit only looks modest, and the reason I say that is Mexico, for their agricultural imports, gets a majority of their stuff from the United States, okay? And that was tariff-free with NAFTA, so not a whole lot's changing with the new agreement. As I mentioned a moment ago, new tariffs start Monday on Mexican products. That's import of products from Mexico. We are optimistic that Mexico won't slap any retaliatory tariffs on U.S. products. They seem to want to work with the Trump administration to get a deal done. And again, we suspect this will get done. If relations were to sour with Mexico, then that would be a big deal for the U.S. agricultural markets, okay? A big deal. They are a bigger deal probably than any other trade partner we have. They are a major importer of U.S. agricultural goods, from proteins to dairy to grain, okay? Japan has numerous quotas and tariffs in place on U.S. ag products. What's key here is Japan recently initiated the Trans-Pacific Partnership 11 and a free trade agreement with the European Union. We have been concerned that the United States might be losing a little protein market share there, but there are negotiations going on with Japan. Rumors are that a U.S. deal will be done with Japan by August that will lower Japanese tariffs on our products to TPP 11 partner levels, okay, which will give us a level playing field. Japan recently lifted the age restrictions on cattle from which it can import beef from in the United States, which has been in place since 2003. Again, that is a part of an action that I think shows that we are on the road to a deal, but also speaks to the challenges that African swine fever is having on the protein supply in Asia. Okay, and we'll talk about that more in a minute. And I would offer that, and we'll again show this to you in a moment. I would offer that this is our biggest risk of bigger export demand in the near term, and in the near term I mean late 2019, 2020. China negotiations continue, if you want to call them that. Obviously, I would guess everybody knows that China has implemented notable retaliatory tariffs, including on proteins, dairy, and grains. The most important one is soybeans. Relations are souring. Deal is not likely anytime soon, in our opinion. I think that it would be a surprise if we got a deal before the next election. China is also dealing with African swine fever in their swine herd, which is disrupting some trade flows, and we'll talk about that more in a minute. South Korea trade agreement with South Korea implemented in March 2012, various quotas and tariffs on U.S. ag products. Korea not part of Trans-Pacific Partnership 11, no major negotiations occurring, but there is a risk of U.S. export expansion, and probably more so due to African swine fever. So as we talk about, as we move forward, we also want to talk about some other issues like African swine fever that are impacting trade flows and impacting negotiations. And with that, I'm going to turn it over to Isaac.
All right, I appreciate it. So just a quick lead in here. We did talk about ASF, African swine fever, quite a bit in our last month's webinar. So if you missed that or wanted to recap it, go ahead and reach out to either myself, David, Jerry, or Kate, and we can send you over the video recording of that. But it was, again, about an hour-long presentation with quite a bit of information. But, we're looking at other trade issues, and we're talking about ASF. And a lot of times when we make that segue, people look at it and say, well, how is ASF a trade-related issue? The big thing that we're seeing here is it's impacting pork production on a global scale. So a brief recap, what is ASF? It is a highly contagious, very deadly disease that affects pigs. And this is only pigs. No human health impacts are known at this point in time. But the big thing is it's hit the entirety of China. All 100% of all Chinese regions have been affected, and it's even moved throughout almost the entirety of Southeastern Asia. So we're seeing Vietnam, Taiwan, Cambodia, North Korea. Hasn't been in South Korea yet, but the expectation is that it's probably going to reach South Korea as well. But it's in Russia, Poland, and other parts of the EU. So it's a fairly widespread, highly impacting disease that we're seeing. The expectation is that we aren't even seeing the full impact. So China, obviously data out of China is always a little bit of hit or miss, whether you believe it or not, whether they're accurately reporting or not. But for some perspective here, China has reported 143 cases since the first one in August. To compare that, Vietnam has reported more than 169 cases since February. So we can kind of see the disparity or discrepancy in reporting there. China is saying, about 1 million hogs have been culled. Vietnam is saying 1.2 million. So again, we can see the discrepancies in that data and that accuracy or believability of what they're reporting. When we talk about these things, everybody always asks, is there an analog year? Is there something we've seen in the past that was relatively similar? The answer is no, but kind of. And to make a comparative analysis would be 2006 through 2008, China went through PRRS, P-R-R-S, or also known as blue ear, reduced the herd by about 8%, took out about 1.2 million hogs, which should be about where we're at right now in China's overall decline. In that time frame, hog prices skyrocketed up 90%. We haven't seen that type of rise in China yet. What that tells us is either A, they're using a lot of cold storage, so they're having pork reserves that they're leaking out into the marketplace, and they're not relying as heavily on imported products, or B, we're not seeing the full effects. China is obviously giving some government aid and helping keep prices deflated. That's likely the case, is that China is probably offering some government aid there. But the big thing that we're looking at, the biggest difference between blue ear and ASF moving forward, is that ASF impacts are likely to be much greater and extend for a longer period of time. So we are looking for about 25% of the overall hog herd to be decimated. We're probably talking about somewhere in the area of 24 to 36 months before we see a recovery. The big thing is this will probably become endemic in China. It's very, very difficult to stop the spread of ASF because it is spread through ticks, it's spread through feed, it's spread through wild boars. So the expectation therein is that they're going to be battling this for a long time. Even if they do secure their herds, it will still be endemic to regions in China. And the last little point there, 12 million metric ton protein supply gap. We're expecting China's pork production to drop by 12 million metric tons. For comparison, that's the equivalent of what the United States will produce in pork this year. So that's a huge decline that we are expecting moving forward. So on the next slide, we'll see the overall trade impacts moving forward. Obviously, we have seen some consumptive decline in China. This has been going on since 2014, but the expectation is that we'll obviously continue to see consumers straying away from pork and probably shifting more towards beef and poultry. We don't believe that China's beef production will be able to keep up with the increase in demand. So we're starting to see global trade flows shifting here. This is how ASF becomes our global trade issue. We do expect China to increase their imports this year by about 20% on beef. And the big thing with pork and chicken is, from a historical standpoint, Chinese herd growth was able to sustain their consumptive needs. They weren't having to import as aggressively. But what we're seeing now, obviously, ASF depleting their herds. Last month, China's official statistics from the Ministry of Agriculture showed that their imports were up almost 50% year over year. On the chicken side of things, we have heard quite a bit, and some of the folks that we've talked to that have contacts throughout Asia are saying, yeah, we're going to see more chicken production growing in China. The biggest issue that China has with growing their domestic flock is high path avian influenza, so HPAI, as well as aging genetics. So they continue to battle avian influenza issues. It always crops up about once every couple of months, and it takes out a whole flock. The big thing is Chinese consumers have limited confidence in birds produced in that region. They had quite a few people die from contracting avian influenza, so eating birds that were infected with HPAI. And when consumers die in China, it's especially catastrophic. It really lowers their overall confidence in their food and foodstuffs that they eat. So one of the big things we are looking for is probably a sharp rise in chicken imports into China. So looking at how trade flows are shifting, those last couple of points there, we'll just go through those very briefly, but Australia is shipping more beef to China. We know that. It's not a speculation at this point anymore, but for comparative sake, China accounts for 8% more of Australian export potential now than it did in August. So August is when the first ASF case hit. Australia is now shipping 8% more beef to China than they did back then. We're seeing Australia neglecting Japan and South Korea. So share of exports to South Korea and Japan has dropped by 3 to 5%. So one of the things that we know now is that Japan is seeking beef alternatives other than Australian beef. They've come to the table with the United States, and they've begun negotiating how they can get more beef from the United States. And on the pork side of things, Canada is now importing more U.S. pork. So pork imports for March were up 14% year over year. The big thing that we're seeing there is that Canada is shipping more pork to China. So Canada is sending pork out the front door. They're bringing U.S. pork in the back door. The big thing that we're seeing there is volumes are up from Canada to Australia about 15%. So they are more aggressively moving pork into their export market. China is taking up a larger share of global protein flows. On that next slide, we'll talk a little bit about proteins there, but what about crops? So this whole thing isn't just on the protein side. One of the major things that we're also seeing is obviously corn crop concerns. So as of June 2nd, about 67% of the entire corn crop has been planted. That comes as the lowest number of plantings historically that we have on record. It's been persistently wet, and we are not able to get the crop planted in a timely fashion. We do expect that throughout this week we will see some very aggressive plantings. But one of the things that we know that we'll be battling is prevent plant or insurance dates. And as we start to look at how that's impacting overall plantings, the expectation is there's somewhere in the area of 800 million to about 1 billion bushels at risk moving forward. So we'll probably see a historically large prevent plant acreage this year. What prevent plant is if farmers can't get the crop in the ground, they have been prevented from planting. So prevent plant is their insurance that they're going to take on acreage that they cannot get planted. Expectations remain for somewhere in the area of about 4 to 6 million acres. There are some economists out there that are looking for somewhere in the area of 10 million acres. In our view, it's a little bit of a high side. We have seen higher corn prices encouraging U.S. farmers to plant. But again, the expectation is about 1 billion bushels are at risk here. But from a global standpoint, what is this doing? Higher U.S. corn prices are encouraging South American farmers to look into planting more corn next year. So one of the things that we know is that South America is becoming a relatively large global agricultural trade supplier, whether it's soybeans, corn, beef, poultry, pork. Brazil, Argentina, Uruguay are dominating the marketplace. So as U.S. corn prices or U.S. soybean prices are increasing, the expectation therein is that South American crops will have a better international global share of the marketplace. One of the things that we saw was this happen in wheat. So over the last decade, U.S. wheat has become considerably less competitive in a global marketplace. We export considerably less wheat now than we did 10 years ago, and a majority of that is due to an increasing Russian crop, an increasing European crop, as well as Australia taking a lot of business away from the United States. So, next slide. So from an expectation standpoint, where do we go from here? What's moving forward? David did a good job of going over this on that market recap slide. But just from a country by country standpoint, the expectation from NAFTA, from our USMCA partners, are that this deal will get rolling. It will get going here within the next 3, 6, 8 months. We do believe that a deal is in the works to finalize USMCA. obviously, our new import tariffs with Mexico are throwing a wrench into our expectations. They're going to slow some things. But again, we do believe that Mexico does want to come to the table, that we do believe that this will encourage some expeditious resolutions. At the same time, we are weary of the fact that there could be some retaliatory tariffs placed from Mexico moving forward. As far as South America goes, we went over the fact that South America is becoming a dominant global piece in the agricultural world, whether it's corn, soybeans, pork, poultry, beef, you name it, they're probably shipping it, and China is their largest partner in most of those items. We don't see a whole lot of opportunity with the European Union. There's not a lot of back and forth that we get with them, some small items maybe, but the expectation is that opportunities remain relatively limited. China, so we went over China quite a bit earlier, but the big thing with China is those negotiations have soured, but there is a lot of upside if we do get a deal going forward. So again, we don't expect anything in the near term, but again, the longer term risks remain relatively robust. Japan and South Korea, both of those, we are looking for a trade deal with Japan moving forward. So something similar to TPP-11 or CPTPP has also been named a comprehensive and progressive trans-Pacific partnership. It couldn't have picked a longer or worse name for it, but CPTPP, which includes Japan, Australia, New Zealand, Mexico, Canada, Vietnam. So some major trading partners. The expectation therein is that the U.S. will be able to negotiate a bilateral deal moving forward with Japan. And lastly, Australia. So we are seeing Australia servicing China more aggressively. Australia is neglecting some of their longer-standing trade partners, South Korea, as well as Japan. That does leave quite a bit of opportunity for the U.S. to regain some market share in these areas. But from a trade perspective with the United States, the U.S. does bring in quite a bit of lean beef. So your imported 90s, your imported 100% lean beef that goes into most of our manufactured products, so ground beef to make different style burger patties. The expectation therein is that this will impact our lean beef trimming prices. We do expect imported lean to increase in price, but the big thing there is Australia is also dealing with persistent dryness. It had some herd reductions there. There was a fairly sizable flood that impacted about 500,000 to 800,000 cattle throughout the New South Wales, Queensland area a few months back. And that's obviously going to affect their herd longevity moving forward. How long will they be able to continue to service China as aggressively remains to be seen. But our estimation is that from a global standpoint, prices will go up as Australia cuts back on what they have available. So what's at risk? If we could quantify the items that we have at risk, this is one of our models that we put together here, where basically we're looking at what we produce and an aggregate export total for each individual product. Points to note here are the higher the number, the more export potential we have for that given commodity with that given country. So we'll take China, Hong Kong, for example. It's a great example. The export potential for China, Hong Kong on beef is fairly sizable. We believe that we have an opportunity there on the beef side of things. There are some longer standing issues that would prevent us from capturing that market share as aggressively. China does not allow for feed grade antibiotics or growth promotants to be used, and that's the majority of what we use here in our feedlot operations. So that kind of discounts that, but the opportunity for the United States to capture market share if product was available is great within China, Hong Kong on the beef side of things. Non-fat dry milk, pork, soybean oil, and soybeans. So we know that soybeans are a fairly sizable marketing opportunity, especially from 2018 into 19. We haven't been exporting soybeans to China as aggressively. We have a large supply of soybeans here domestically that looks burdensome at the moment. And the expectation is if China opens up that marketplace, we have a huge export opportunity on soybeans moving forward. Very similar things. We look at a majority of the Asian countries, Japan and South Korea, pork, broiler meat, cheese, as well as pork. Beef, and then as well as pork, where pork has a lot of opportunities moving forward. Japan, Korea, Mexico as well. One of the things that we touched on was how wheat has lost its global footprint in the export market. So we see that across the board, save for Canada, wheat does have an export opportunity moving forward. One of the things that David and I and Jerry have talked quite a bit about is that if there are any catastrophic issues that happen in Russia or the European wheat crops, that the U.S. stands to be the largest benefactor here. So the risk is likely to be upside that if there's anything that happens with that wheat crop on a global scale, the U.S. has export opportunity or potential moving forward. So use this kind of as a roadmap moving forward as we start to talk more about trade deals being reached with China or maybe with Japan or South Korea. What are the items of interest and what are the ones that have the most risk, the ones that have the highest numbers here moving forward? So on the next couple slides here, we'll just kind of recap what we talked about. The biggest thing is, what does this all mean? Pulling it all back. So in summary, more than 800 U.S. food and ag products have been tariffed or have been affected since mid-2018, since we put on these steel and aluminum tariffs. ASF is shifting trade flows. We know that ASF in and of itself is not a trade issue, but it is causing a dynamic shift in the global marketplace. We are seeing opportunities for the United States to regain some portion of business, whether it's with China directly or through an indirect cause like Canada or moving into Japan more aggressively. We do see a trade deal with Japan forthcoming. We do believe that is one of the top risks in this whole global trade flow, is that we will begin servicing Japan more aggressively with some of our protein items. So a lot of what Japan is going to take when they shift away from Australian beef is going to be domestic cow cuts. So we'll be talking about beef from cattle over 30 months of age. A majority of the products that are likely at risk, if you're buying no-roll beef, which those of you that aren't familiar with grades, prime, choice, select, but no-roll is kind of towards the bottom there. But the no-roll type beef, we're looking at briskets, we're looking at inside-outside rounds, some random chuck items here and there, and short plates. So there are quite a few items that we are going to start shipping to Japan moving forward. And the big thing there is that's going to impact domestic lean beef prices. As we start to remove that cow beef production, which typically would go into the grinder and become domestic 90% lean beef trimmings, is going to be leaving now as whole muscle cuts, briskets, or inside-outside rounds, that type of thing. And the last one on this slide is shifting trade flows, leaving global opportunities abundant. We're looking for beef, pork, beans, and wheat to see some expanding export opportunities, mostly with our Asian trading partners. On the next slide, we just talk a little bit about the import tariffs. So what's the most at risk here? Following the removal of U.S. steel and aluminum tariffs, USMCA was looking more favorable, but the risk now is that we have these new tariffs on Mexico that could stall some of the negotiations that we were expecting to see. Obviously, it does throw a wrench into that negotiation process. But as David stated, we do believe that both sides will come to the table to find an amicable resolution, and hopefully this will allow USMCA to move forward. Import tariffs on Mexico remain sizable risk. Right now, they're just 5%, but they're going to go up by 5% every month until October. That will put them at 25% if we make it all the way to October. The major restaurant table items that would be affected: tomatoes, onions, avocados, and other fresh fruits, as well as beer and wine. And those are likely the biggest risks that we see moving forward from these import tariffs. If Mexico decided to place retaliatory tariffs on the U.S. by value, we believe that the items that would be most at risk would be corn, soybeans, dairy products, pork, beef, and then poultry, and then wheat. So those are all bulk or consumer-oriented goods. If they did put a tariff on them, expectation would be that prices would drop relatively significantly in the immediate. That would obviously hurt the U.S. farmer, but would be advantageous for buying opportunities moving forward. So do keep an eye on retaliatory tariffs, but as well as ongoing trade negotiations. So speaking about prices moving forward, I'll pass it over here to Jerry about our pricing outlook moving forward.
Yes, thank you, Isaac. Appreciate that. Welcome all. going back, as many of our ArrowStream commodity clients know, we like to look at the markets and the potential of what the markets can do on a quarterly basis. We write a lot about our pivot models, and what that basically says is what the market is capable of doing at certain times. What I did do for this slide is I went back a couple slides ago. Isaac showed you that trade risk, what's important to monitor, showing you the 6 partners and what those percentages of our production were, which I think is a great slide. What I did from there, though, is I took the cumulative production estimates. So from those 6 partners. So the top 3, I'm going to exclude soybeans. That was a big number as well, but soybeans right now, there's a big global supply of that. But outside of soybeans, the highest is pork at 35% of our production. So looking interesting at the pork sector, we do have year-over-year inflation happening. It's not just because of, well, we've talked about ASF. Obviously, that is a major component why the market's been firm. The USDA pork cutouts up 16.7 year to date. Ham prices are up 30% year over year. Pork trim prices are up notably 40% year over year. I just want to mention, though, last year's prices, though, to be fair, were fairly low, over the last couple of years, but there definitely is some inflation happening there. If you look at the table here, basically I got 2018 average price versus where it is currently in 19. For example, pork bellies are actually below, just above $1 per pound. But our upside targets over the next couple of weeks suggest that the markets, if they get going, and keep in mind, pork bellies are a very volatile market. So this is the upside potential in those. Now that's probably a little bit rich, but bottom line, what you want to take from this is that from where we're at, especially considering all the other pork markets, you can see hams, spare ribs, and even like the trim, as I just mentioned, we're all trading at premium. So if anything, we've been telling, we like bellies where they're at right now from buying. So keep an eye on pork is what we're getting from here. Of these sectors, of what we're talking about here today, definitely have to keep our eye on pork and where we're going from here, because double-edged sword. We have trade potential, more customer business down the road, possibly. Plus we have ASF. So I just want to reiterate that. The next sector is wheat at 34%. Interestingly, as Isaac also mentioned, that global wheat supplies are in very good shape. The markets haven't, they're actually down year over year. Most of the wheat markets average around 14 to 15%. Again, due to global supplies, and we've had some recent weather challenges as of late. But again, 34% potential, as Isaac also mentioned, that hey, if there's a hiccup out there in the global community, it can bring support to the market. So soft red winter wheat, your higher protein wheats, I got some numbers here to have some upside potential as well. So I did put soybeans here because soybeans, as I mentioned, with China is a big component, but maybe some modest upside potential from here. But again, global supplies in very, very good shape. The last thing I'll mention is corn. Although corn wasn't a huge number, I think from a business, it is still a very important commodity, especially for the feed community, right? Feeding the animals, so we're always keeping an eye on that. Obviously, we're having the hiccups with weather right now, and corn prices are actually above their quarterly R1 and R2 right now, which says, hey, listen, there still is, what does the market do from here? Weather's improved the last few days, but I did put here a yearly. We also look at pivots on the yearly perspective. If the markets get a little hairy from here, weather doesn't improve, 455-ish, we're thinking you see some resistance if we get up there. And then the last sector I want to talk about is beef. Both David and Isaac talked about beef trim. Your lean beef trim is a very important component to our hamburger and ground beef prices here in the United States. We are naturally short. We do need to bring some in from other parts of the world. And as we've talked about, we got to watch those prices. So currently, domestic 90% are pretty firm. We do have some pretty near targets, 226, 233 on domestic. I was also looking at import 90% beef trim. They're up about $0.10 year over year on our weekly commodity report. I looked at that before our call today. So we have to keep an eye. I did a short plate as well, holding firm, upside potential there as well. And then I put chicken in here too. Not even though it's not a huge number as far as excess business, we do obviously it's a very big domestic product for us here. I did, chicken breasts are seasonally declining. They are below, but I did put some upside targets. And we also look at leg quarters as well. Leg quarters are a big export poultry item for us. And, two thoughts there, again, with trade potential, but also with ASF. We wonder if we've been talking as a group here, is that supporting other protein areas as well. So just wanted to leave you with that. And next slide, I think Kate's going to take over from here.
Thanks, Jerry. So we're now at the Q&A portion of the webinar. If you do have a question, please go ahead and type it into the questions box. I do have a couple here for the presenters. The first one is, can the pending value of the US dollar versus the currencies of our key trade partners enhance the commodity flow potentials even more?
Yeah, I'll take that, Kate. This is David. So for those of you who subscribe to our services know we have a agricultural currency index that we track against the dollar, and that's our major trade partners. And I will tell you that the dollar is near 3-4 year highs against that index. And so a higher dollar is typically bearish commodity prices in the United States, as it discourages exports. It makes our products more expensive overseas, and it encourages imports. If for some reason we were to get some significant weakness in the dollar, it certainly would encourage exports. Okay, but I don't think that's very likely at this point.
Okay, thanks, David. We have a next one for the group. With China's African swine fever challenges, what will that mean for the global demand potential going forward for other proteins like chicken or beef?
That's a good question. Thinking about it from a holistic scale, it's really going to be dependent upon which country we're talking about. So China as a whole, we do know that for the last decade, we have been talking fairly fluidly about a rising middle class in China. We have been talking quite a bit about Chinese consumers becoming more sophisticated, seeking higher priced goods. That puts the onus on beef to move into that marketplace. One of the things that we've been seeing from the U.S. trade representatives, such as the Meat Export Federation, is they are going over to China. They are teaching Chinese consumers how to cook whole muscle cuts rather than using thinly sliced beef in their meals. We're seeing more hotel and restaurant industry offerings of whole beef muscle cuts as opposed to traditional pork style dumplings or used kind of as a thinly sliced meat. The expectation therein is that it's probably going to increase demand for both beef and chicken, but on different scales. We'll probably look for Vietnam to pick up some of their chicken export potential. But as Hong Kong has recently been hit with ASF, and it shut down their largest pork processing plant. This is last week. The expectation therein is that we're going to see an increase in beef consumption in Hong Kong. Beef is a fairly sizable portion of protein consumption for Hong Kong consumers. And so we expect beef to really get a good rise following some of these issues with ASF throughout Asia and Southeast Asia.
Thanks,
if I could address this. Yeah, if I could just say one thing, particularly on chicken. For most of our customers and most of you on this call, chicken exports are good news because we export almost entirely the back half of the bird or the dark meat. In the United States, we're mostly front half of the bird or breast and wing buyers, right? So what can happen with what will happen with increased exports, and we have seen increased exports, and we have seen trade flows improving for our leg quarters, because leg quarters are near 3-year highs, right? But what happens with that is that adds to margin for these chicken producers, which encourages them to produce more, which can push breast and wing prices lower. So so long as, and we don't anticipate at this point that we are going to get runaway feed prices, but I encourage you to tune into our webinar when we know more next month. But so long as we don't get runaway feed prices, increased exports for leg quarters should help most of our clients and most restaurant chains in the United States. Regarding beef, probably the biggest risk in the near term is, and Isaac, feel free to disagree, is around lean beef trim and those cuts. And so we certainly encourage you to keep an eye on those.
Thanks, David. The next one for the group is, could we comment on the potential sugar impact as a result of the new import tariff with Mexico?
So we're going to have to do a little bit more research on that and get back to you. But if you don't mind sending us an email, we will certainly do so.
That sounds great. And then I had a couple of other people wondering about the getting a copy of the presentation. So everyone will be, later today, we will send out a recording of this webinar. And then as always, commodity report subscribers and forecasting customers will get also the PowerPoint slides. So thank you everyone for your questions. We appreciate that. Again, we'll be sending out the webinar later today, and also in that email for those of you who are interested in learning more about our strategic sourcing and commodity intelligence tools, there will also be a link to a form in that email for you to let us know to contact you with more information. And again, our upcoming webinars, we have one in June 27th. We'll be talking about best practices for sourcing strategies, and July 18th we'll be digging deeper into the U.S. corn crop and its impact on other markets. So again, thank you to our presenters and for everyone who dialed in today. We look forward to having you on our next webinar, and have a great day.